Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I am just going to analyze the markets and talk about what's going on. First of all, the US dollar index has declined for 2 consecutive sessions, engulfing both previous candles almost, while it's nearly identical with this fourth candle right back here. Now, again, what's the main driver behind the US dollar index pulling out? Are pulling back, and the main reason is the Euro-US dollar and its pretty significant bounce. Again, I mentioned this in my blog, in a blog post a couple days ago on March 14th, which was exactly 2 days ago, right when we hit that 1.310 area. I said there's a likelihood that the market will eventually bounce, and once it bounces off that 1.3 area, you can anticipate the dollar index to eventually pull back. Once it pulls back, I anticipated the Dow component to complete another move upwards, which I highlighted in my blog post, and I recommend all of you guys to go ahead and check out my website, as it does have a lot of good information, as I'm not always creating videos. And of course, just so you all know, it's free, so just go ahead and check out www.fitrade.com. Now, that being said, we're talking about the Dow component average, and we're trying to think for a second, just how far can this market go? Well, in my expectation, and from what I'm seeing, I think that the Dow component average is reaching its peak. And what I mean by that is that the Dow component has already reached its previous resistance area back in April of 2008, where the markets kind of peaked up a little bit before falling even lower to that downtrend that happened throughout the whole entire Great Recession. However, that being said, exactly how much higher can the market go, and will this resistance area hold? Well, I think it will, and the main reason why is because it's a psychological area where people would want to take their profits. And again, the longer the trend line is, the more valid it becomes. Remember, going back before, we've had times where the markets would pull back from previous areas of resistance, like this one, at around 12,000. Markets kind of struggled above 12,000 before it eventually kind of had a nice little dip. Okay? And the whole idea that I'm trying to bring out to you guys is that it might continue a little higher, but I don't think markets are that optimistic. I think people aren't going to push it that much further because we've already had a significant series of gains, and I think eventually people want to take their profits at around the 13,000, 1200 area, as it is a previous top, which can be seen as potential resistance. Alright, but again, it also depends on the dollar index. If the dollar index if it continues to go lower, which would rely primarily on the Euro-US dollar to continue going higher, perhaps the Dow component could squeeze out some additional gains, as this market is very currency driven. I also want to mention, though, that the Euro-US dollar is running into that 50-day moving average, which could make it difficult for the Euro-US dollar to continue heading higher on the Sunday open. But if it did go higher, or if it does go higher, that will most likely cause the US dollar index to continue going lower and the Dow Jones future contracts to continue going higher, which would imply more upside bias on the Monday session. I also want to mention the fact that a lot of economic data has been coming out relatively good, which is another reason why this market has had no issues continuing to trend higher, as the Greek issues have no longer become the main priority of investors, as people shifted away their focus from Greece back to the fundamentals of the stocks in question, which can be seen as a good thing. But all things considered, if in the event that the Euro-US dollar is not able to break that 50-day moving average, chances are the US dollar index will be able to continue going higher, and that could eventually lead to the Dow component pulling back. So let's watch the currencies very closely. It's not always exact, but usually currencies are a very good leading indicator for the equity markets, so it's always a good idea to pay attention to them. Moving on, the S&P 500 cash, same issue again right here. This is the April 2008 top or peak, and we're running into that same exact area. Now again, perhaps we can squeeze around 8, maybe up to around 1,410, but again, I really wouldn't bet on it, and the main idea here is that perhaps markets are a little overextended. I know markets, market participants are optimistic, a little more optimistic on the future, as we all have been for the past 3 years now, 4 years now, coming out from 2009. So You know, for the past 3 years, we've been optimistic, we've been investors, we've been going long and stuff. However, I still am a little cautious on the S&P 500 index, and it comes back to what I was saying about the Dow component. This is a very key psychological area, and if we're not able to break above it, don't be surprised as people may consider this as an opportunity to start taking profits. And we've also seen a pretty decent spike in the volume as of lately, which could mean a leading indicator on perhaps an eventual pullback. Remember, high volume is always an indicator of potential selling in the future. The higher the volume gets, the better of a leading indicator it becomes on future selling. So just watch it very closely and be wary of that. The gold market has been able to find some support at around 1,640. And then has been able to bounce for around 20 more points. However, in this chart, I am a little cautious on it. Again, the main reason being is that gold has been in a consistent downtrend, and the gold market has been following the fundamentals of the dollar much closely than the stock market, because the stock market is able to rely on economic fundamentals, whereas gold is just a commodity that trades based on buyers' interest. And right now, a lot of buyers aren't as optimistic inside of the gold and silver market. We've seen data suggesting that the silver and gold mints in the month of February weren't able to sell as many gold and silver coins to investors. So that can be seen as a sign of perhaps a lack of confidence inside the precious metals themselves. Also, I want to mention that the US dollar index has been able to gain for the past, let's see, 3-4 consecutive weeks, and that could also be another primary reason behind why the gold market has been able to fall for the past 3-4 weeks, or 2 to 3 weeks. Again, this all has to come back to the dollar again, and we've also closed below that 200-day moving average. We've kind of broke below it. We tried retesting it. We couldn't really break above it, and then we continued going lower. And again, therefore, there is no significant moving average to support this market, at least for now, and therefore I am bearish on the markets. At least on the gold. Silver, same exact story here. It was able to get a decent bounce off that previous area of support based on the December rounding top area, along with the previous support area it has been able to find in the past, which would be a bullish flag pattern, which again, it kind of retests that and it kind of comes back together. And eventually the market bounces off that a little bit. But again, watch the dollar closely. If the dollar starts to go higher on Euro-US dollar weakness, the Euro-US dollar starts to pull back from that 50-day moving average, chances are gold and silver will struggle on the Sunday session. Moving on, the volatility index, again, it has had a nice little bounce that day, but it seems to have been a lot of fluff. But again, investors seem to be kind of interested. They're still nibbling at it, even though the markets have had a significant up move. I want to point this out to you guys because, again, we're going back to the Dow Jones Industrial Average. 200-point gain on a single session, and the fact of the matter is that a 200-point gain is actually a very, very good day on the markets. It's around 1.5% gain for the broad indices, and for some weird reason the volatility index was pretty resilient and only fell by around 1 to 2, maybe 3% at most. But typically on days like that, the volatility index will flump and just crash and fall anywhere from around 5 to 10%. So that people are still holding on to their volatility index positions, and they're not willing to sell them as much, which could be another leading indicator that perhaps this market is starting to gain interest, and perhaps people are starting to smarten up and are starting to hedge their positions. I also want to point out that the percent K has crossed above that percent D, which could mean that there is perhaps, and I'm just saying perhaps a difference in buyer's mentality, and of course the percent K crossing above the percent D is indicative of perhaps more upside. And again, oscillators are pretty good at this, as every time we've seen this percent K cross above that percent D, we've seen the markets kind of pull back and pull back because it is a lagging indicator. But this time it could be a little different because, again, we're waiting for markets to pull back from those major areas of resistance, and people are becoming more resilient to price action. Yoku.com. This is a very interesting stock because I was talking about it in my blog quite a bit. I've kind of released a lot of blog posts in regards to the Yoku Tudo deal, and you know, the thing is, investors kind of just realized that Yoku kind of bought out Tudo. Tudo is a company that's still going to operate separately from Yoku, but at the same time they bought it in an attempt to gain more market share. The issue with buying out Tudo, though, is that Tudo doesn't have exactly what you would call some marketable advantage. Another thing to notice is that in the Chinese demographics, people like professionally produced content. They don't like user-generated content as much like they do in the United States. Therefore, Tudo doesn't have an exact advantage yet in the markets, and it's not necessarily a premium brand like Youku.com. Another thing to consider, though, is that Youku and Tudo are going to operate on two separate websites, meaning that it's going to be like Google owning YouTube, and then Google also owns Yahoo Video. What's the point in owning two video companies when you can just take your money and perhaps invest it more heavily into a marketing campaign to promote the brand you already have into brand dominance? Because from my understanding of the internet space, typically companies that operate in the same segment buying out each other doesn't work as well because the audience is kind of split between two websites, and unless there's significant there's perhaps a different niche that these two operate inside of, there could be an advantage to having a merger. But the problem is both Youku and Tudo.com both operate in the same segment, the same market segment, and it seems more like two competitors are kind of competing in the same space, and it doesn't seem like it's going to be a very good merger, as these two are kind of not, you know, they're competing with each other, and it's not really adding much brand value. And what I mean by brand value is that YouTube can charge an added premium because they dominate, whereas since Youku and Tudo are separated, the value of both of those brands diminish as they become more popular in the internet space. Another thing is they can also charge, they end up charging less because they're competitors, and neither of them are going to merge into a single site because, again, they're perhaps afraid of losing viewership. The one upside potential that I could see, though, is that perhaps Youku and Tudo.com could end up sharing the same content on the same servers, where you could find perhaps a video on Youku that could show up on Tudo's website, and vice versa, where you're on Youku and you can find a video that's on Tudo. That happened with Gmail, or not, but Google Videos when it bought out YouTube. So that could be seen as a positive thing. But again, you know, what's the point in having two brands then? That's the question I want to ask as well. So it's going to be a really tough, I guess, area to navigate. And I also want to mention that Youku.com did buy out Todo at a ridiculous premium, and in the end, the Tudo shareholders get a huge end of the bargaining stick, and they're the ones that really are the winners behind this whole deal. And it makes you really wonder if Youku is really good at investing their money. Therefore, the stock has continued to kind of has pulled back quite a bit. And as Tudo shareholders continue to, I guess, sell their stocks or something like that, I mean, Tudo shareholders are free to take their profits at this point, and and I guess it's a very good deal for the Tudo shareholders. And once those companies merge together, there's going to be a surplus of Youku shareholders who own an excess of Youku shares. And since the Tudo shareholders have already locked in a 200 to 150% profit, they're free to walk out and collect those profits, and it's a done deal, and the stock could pull back on profit taking. So we'll wait and see. But right now, Youku is having a hard time, and it could continue to go lower. That does it for me for today, folks. If you have any questions, leave a comment right below.